Participants are in.
All the participants have already been admitted.
Yes.
Okay. Good evening, everybody. It's a pleasure to welcome all of you at this study circle meeting on a very intricate topic. See, basically, the entire interpretation of DTAA finally culminates in this Article 23, where the actual elimination of double taxation takes place. Because otherwise, the taxing rights are allocated, who can tax what and how much, etc., at what rate is there in the other articles. But the real challenge or the real benefit under the treaty, I would not call it a challenge, it is a benefit under the treaty, is that when the resident country taxpayer gets credit for the taxes paid in the source country, and there are several challenges associated with that, both under the treaty as well as under the domestic law. And we have got with us Sushil Lakhani, who is a veteran in international tax, who has been a past chairman of IFA India. So I will request Kush to introduce him first, and then I will request Sushil to take over the proceedings.
Thank you, sir. As Nilesh sir said, I don't think in the international tax community we need to introduce Sushil sir, but I still do so. Sushil sir has experience of more than 40 years in international taxation, and he's a rank holder in not just inter but also final CA examinations. And as Nilesh sir said, he's been a past president of IFA, chairman of IFA India, and is currently on the executive committee of IFA India as well. He has written several books, including books on TDS on payments to non-residents and foreign companies, and a monogram on EPC contracts, and also a publication on expatriate taxation. And he's an expert on international taxation, transfer pricing, and FEMA. And I think there's no one better than him to take us through this topic, which is very challenging and interesting. So Sushil sir, thank you so much. I'll hand over proceedings to you.
Thanks, Kush and Nilesh, for your kind words of introduction. Welcome to all the participants. Well, the topic allotted to me today is foreign tax credit and related practical issues. It is, in fact, to be very honest, when I went deeper into this subject, basically with a view to prepare for today, even I was quite amazed at the amount of controversies which are there. Some of the controversies I was aware of, but most of them, even came as a surprise to me that a topic which apparently looks so simple could have so many issues and so many interpretations by the courts. So we are in for an interesting 1.5 hours, and I'll try to share whatever I read and whatever I hope at the end of the session, the participants take away some useful, interpretations and analysis. With that, let me get to the topic.
Just one question before is that you would like to have the questions at the
end. I would prefer at the end because there are quite a few intricate issues which I feel we should cover. And I'm sure I'll try and keep around 10 minutes plus at the end. And in case, if we fall short of time also, I would not mind extending by another 5 or 10 minutes. So I would feel, so that we can get the entire flow of the topic. And all questions I would be happy to answer at the end.
So just one, also note to participants that we will share the presentation after the session. So in case that question was there.
Yeah. Right. So with that, I think take up the topic. Now, these, friends, are the relevant provisions which one is dealing with today. In the Income Tax Act, there are 3 sections, 90, 90A and 91 of the Act, which deal with foreign tax credits. There is a new section 89 capital A and a corresponding rule 21 triple A, which deals with credits and taxation of amounts received by residents of India who were earlier residents of US or any other country on their retirement funds which they had invested there. Then we have Rule 128 of the income tax rules, which is basically the foreign tax credit rules of India, which were introduced somewhere in 2017. Along with that rule, they introduced Form 67, which one is required to file with the return of income to claim the credits. Now, when you go to the treaty, you have Article 25 in most of the Indian treaties, and the model, as Nilesh said, it's 23. In some of our treaty, it is 24. Some may have 26. That's not really important. The title of the article is Relief from Double Taxation, which deals with foreign tax credits. And then we have section 40A small 2 read with explanation 1, 2, and 3, which again becomes relevant for the topic that we are discussing. So this is the gamut which we have to cover today. These are the provisions. This is just to now, what I have done is first is the simple, part of Rule 128 and Form 67, because this is our daily bread and butter, so to say, where you have to fill these forms, be aware of these rules, and along with the return. So I thought we'll just complete that and then get to the real interpretation issues. Now, this is the rule 128, which was introduced in 2017. Prior to that, of course, the courts were interpreting as to how the credits are to be granted in India. And then they came up with these elaborate rules. Of course, though they are elaborate, there are quite a few shortfalls, which also I will try to point out, or shortcomings rather. Now, this rules cover about mode of granting FTC. That is fine. Then the year of allowance of FTC is the year in which the income is going to be taxed, that foreign income. Then proportionate allowance, where corresponding income is offered to tax in more than 1 year, then it provides for proportionate credit. Then meaning of foreign tax, which is, what it says is basically the taxes which are covered under the DTAA or the taxes as defined in section 91. Now, both of these are highly controversial, the definition of foreign tax, so to say, the way the courts have interpreted. So I'll come to that separately, but as far as the rules are concerned, they allow taxes covered under the treaty, where treaty is there, and as far as where treaties are not there, then the taxes as defined in section 91. Then tax against which the FTC is available would be tax, surcharge, and cess under the Act. And this was also interpreted by Supreme Court when this rule was not there. Exclusions for foreign tax credit, you can't credit it against interest, fee, or penalty payable under the Act. Now, as far as disputed foreign tax credit, let's say if you have a foreign tax credit, but you have taken it up in appeals in that foreign country, then you will not get credit here. You will get credit in the year in which the income is being offered to tax. If within 6 months from the end of the month of the final dispute settlement, the following are furnished. That is evidence of settlement, evidence to the effect that liability for payment of tax has been discharged, and an undertaking that no refund qua such amount has directly or indirectly been claimed in that country. So basically, it is only after you pay the tax and the dispute is finally settled. Now, finally settled would mean it has to be settled, even if it is at the lower, let's say, commissioner appeal type of a level. There should be no further appeal having been filed by you, or so it has to be a finality. You cannot claim a credit if there is still some dispute going on. Then mode of computing is to be, the amount is to be computed separately for each source of income and for each country wise. So basically, there was a decision before these rules in Bombay High Court, which said that losses of one branch cannot be adjusted against profits of another branch for computing the foreign tax credit. And that is the case. Like, you have to compute it source wise, country wise. And the FTC shall be lower of tax payable under the Act or the foreign tax paid on such income. This is what the rules say. Of course, the courts say something else, and which we will be looking in the next slide, in the subsequent slides. Now, foreign tax paid exceeding the amount of tax payable in accordance with the treaty is to be ignored. That means if you voluntarily ended up paying a higher tax in that foreign country, much more than what is the tax rate prescribed for the source country as per the treaty, then the credit will be limited to the treaty rates and not to the higher level. The foreign exchange conversion for FTC is also provided in the rules, which is TT buying rate on the last day of the month immediately preceding the month in which such tax was paid or deducted. FTC can be claimed even against MAT or AMT. And as far as excess FTC, after you claim for MAT or in case you have a loss, the rules clearly say that the excess cannot be carried forward. So as far as India is concerned, the excess FTC is lost. Documentation is provided. I'm not going to waste your time on that. And then you have, it prescribes Form 67, which it says that to be furnished on or before the due date under 139(1). Thereafter, the CBDT has amended the rule to provide that Form 67 can be furnished on or before the assessment year, on or before the last day, on or before the assessment year where the return of income for such assessment year has been furnished. Refund of foreign tax credit, Form 67 to be furnished. Now, this is an interesting aspect. As far as foreign countries are concerned, they also allow carry backward of losses. We have only carry forward of losses. Some of these advanced countries have carry backward of losses. That means you have, let's say, income in a particular year. In the subsequent year, you make a loss. Then you could even carry back the loss and set it off against the earlier tax paid. So in such cases, the Form 67 requires you to furnish wherever you claim a carry backward of losses in a refund in that country, then you are supposed to file in the form. There is a column which you are supposed to fill and inform. And so the FTC which was given to you earlier could be withdrawn. And this is the Form 67, which is there. I think I'm not going to dwell too much on this. Now, what are the issues with respect to this form? Now, the question has come up whether belated filing of this form can affect my credit. And there are a number of decisions, including Mumbai Tribunal recent decision of Sonakshi Sinha and Bangalore, etc., which said that it doesn't really matter. The same Form 67, if it was not filed in time, can be filed later on. In fact, even even if the return was processed or time for revision has expired, the court has allowed the credit to be given after verification. Then for computing, of course, the rule now clearly provides the surcharge and education cess is to be included for the credit. How to allocate expenses, like you have foreign income and you may have expenses there and you may have some expenses in India also, let's say. So how to allocate expense and compute the doubly taxed income. For this, an interesting decision is Elite Core Technologies of Ahmedabad, which discusses in detail how to compute income from that particular source for purposes of computing the tax on which credit can be claimed. So this is an interesting decision which may be usefully referred. Rule 128 is silent about underlying credit. As you know, treaties have a concept. As far as India is concerned, there are only two treaties where you will get underlying credit as far as India is concerned, that is Mauritius and Singapore. And the rule is silent about how to claim those. It's also silent about state taxes. In some countries, especially let's say USA, states also levy an income tax in addition to the federal income tax. And the question has always been whether the US state taxes could be also claimed as a credit. The rule is silent on that. And the way it is drafted indicates that it will be only the taxes covered by the treaty, which is basically the federal tax. Tax payable in the word used in the rule, this has been, as I already pointed out, there is a lot of controversy on this subject and which we are going to deal in detail. Then tax payable under the Act is to be computed after giving effect to all items of brought forward losses deductions, which causes practical difficulties when we really have a complex case on hand. And an entity which is regarded as a separate legal entity in one country, because in most of these countries, you may have partnership firms which may be transparent, or you may have pass-through entities in the form of funds, etc. And the income is taxed in the hand of the individuals or the partners. So in such scenario, there could be some complications. Also, there are certain countries with which India has signed limited tax treaties. So the rules don't seem to be covering those type of treaties. Then, there is also a decision which says FTC is allowable even if no even if no claim was made in the return or during the assessment proceedings. This was IBM's case in Bangalore. And then the question also arises whether this rule goes much beyond the provisions of the treaty, because the section which gave these power to make these rules empowers the government to lay down the procedure for granting of the relief or deduction, even under Section 90, which is where India has signed a treaty. And so the question arises whether, if suppose the treaty allows full tax credit, can this rule restrict it to ordinary tax credit? That's the way the rule is worded. Does the rule override the treaty to that extent? And in my view, no. But anyway, that issue is alive. And if DTA provides for tax pairing, for example, can Rule 128 restrict it? It seems to, but again, the treaty should override it. And the applicability of these rules to pending assessments would also become an issue. So this, friends, very briefly and very quickly was something on the FTC rules. And now let's come to the real meat or the law on the subject. And that is where the fun lies. Now, in this segment of my presentation, I am trying to cover the two sections in the Act, that is Section 90 and Section 91, and the issues connected with them, as also whether there is an interplay between these two or are they totally mutually exclusive. And so with that, now this is an overview of Section 90 and 91. Now, Section 91 I have kept on the left side, though technically, chronologically, it should be the other way around, but there is a reason for that. Now, 91 is a section which deals with the unilateral credit. That means where there is no existing treaty of India with that country. And there is a general provision that India will allow credit even in absence of treaties. So Section 91 basically is a general provision for grant of tax relief, irrespective of whether the provisions of the other country, when I say state, it means country, as you all know, provides for tax relief. It is also applicable where the DTA does not exist. Now, the question I put after that, can it be extended to even situations where there is a DTAA and there is a court decision, a high court decision to that effect, which has discussed this in detail and allowed it. So that we will come to. So technically, if you read the section, it's very clear. It should not, if you read section 90 along with 91, it would be clear that 91 would not generally apply where there is no treaty. However, this issue has arisen and been held in favor of the SSC. Then tax credit under section 91 is available in respect of doubly taxed income. This is the words used in the act, except for income which is deemed to accrue or arise in India. Now, this is important. Under 91, you can claim credit for all taxes paid in the other country, even if there is no treaty. The only condition is that that income on which the tax is being paid should not have deemed to accrue or arise in India. As you know, Section 9 covers the situations where income is deemed to accrue or arise in India. There are 8 sublimbs to that section, each dealing with a different category of income and providing the source rule. So basically, those incomes do not accrue or arise in India. However, by a deeming fiction, they are deemed to have accrued or arisen in India. So if the credit you want, then the only condition in section 91 is it should not be falling into any of those sublimbs of section 9. And if it is otherwise doubly taxed, then you will get a credit. Then the country of residence, in FTC basically is the country of residence which is allowing credit for the taxes paid in country of source on the ordinary credit method. Now, as you know, I could have possibly, fashioned this presentation explaining to you what is the different methods of credit, ordinary method, and full credit method, then exemption method, exemption with progression method. But I'm assuming that the audience here is aware of these. I'm presuming that, and people who are not aware may please take a little effort and read. These are theoretical, and so because in the interest of time, I thought it would be more useful to cover the issues rather than getting into the theory of the subject. But in simple words, section 91 basically talks about ordinary credit method, which means the credit for the tax cannot exceed the tax imposed in the country of residence on the foreign income. So that's the ordinary method. Full credit, in other words, would mean that you will get full credit for the tax paid outside India, even if there is no tax being paid in India. But so it goes by the ordinary method. That's section 91. And the most important part of section 91 is the definition of the word tax. Now, here you may please take a note. Section 91, the way tax is defined, as you know, even section 2 defines tax, I think 2 bracket 43. But the way tax is defined in section 91 is extremely wide. It includes any excess profit tax or business profit tax charged on the profits by the government of that country or any part of that country or any local authority of that country. So when you are claiming credit under section 91, the word tax is very wide. Under section 91, state taxes, even local authority taxes could get covered. Even sometimes a church tax could get covered if it is a tax on business profits. So if it is a tax, it should not be a tax calculated with reference to business profit, but it should be a tax on business profits. And that could be claimed as a credit under section 91. So 91 is extremely wide. And the only negative is that the income should not have been of the nature covered in section 9 of our Income Tax Act. Beyond that, not only the nature, it should not have been sourced in India under section 9 of that act. So this is section 91. Now, when you go to the right-hand side of the slide, that is section 90, which is bilateral relief. That is where DTAA has been entered into by India. This is applicable where there is a DTAA, and courts have held it to permit credit. And technically, in this 90, the credit is to be limited to the extent of tax provided in the treaty. But the court has allowed credit even for taxes which are not covered in the treaty. And that is something interesting, which we will see in our subsequent slides. Because DTAAs define the taxes covered and makes very clear. And generally, the federal taxes, except in case of Germany where trade tax is covered, but generally it is the federal income tax, as we know, is covered. However, and the section also seems to indicate that that is only the taxes for which credit would be given. However, the courts have held otherwise. Then when you come to, very important aspect of section 90 is the interpretation of section 90 bracket 1 bracket small a bracket small 2. Now, which means, which was inserted in 2004 by way of an amendment. Section 90 basically says empowers the central government to enter into treaties to give relief on incomes which are subject to tax in both countries to avoid to give relief in such cases. And it also provides in this subsection 2, even if income is chargeable to tax in both the states. So it just gives the powers to the central government to enter into treaties to cover such situations. The way this particular clause has been inserted, has been interpreted by the courts is extremely interesting, and we will look into that. Then Indian treaties generally have the ordinary credit method. There are a few treaties which, to my mind, there are few treaties which clearly have full credit method. This one example, Namibia, which has full credit method. But US or Germany or most of these treaties, they have ordinary credit, but the courts have interpreted these treaties to mean full credit. Again, that's an interesting issue which we will be seeing how and what was the logic or the way they interpreted it. And there are only, I believe, around 4 treaties which have the exemption method. That means the income will be taxed only in the source state and the resident country would exempt it. So that's I'm pointed out. And there are 56 treaties which India has signed, which provide for tax sparing credit. Tax sparing credit would mean that even if that country does not tax an income because of certain economic or reasons, gives an incentive, for example, still India, while giving credit, would assume that tax was paid on those and give credit for that. So 56 of our treaties have such tax-paying credit, which again is an important aspect, which we will be discussing in our slides. Treaties, as I already pointed out, list out the taxes covered for relief. And the Article 23, whatever the number which deals with double tax relief, would govern the extent of such credit. Right. And another important point is that generally the way these articles are worded in the treaties, they are worded to make it subject to domestic law. So again, what is the meaning of those? Does it mean that Rule 128, for example, is it domestic law, and can the treaties be set? This article be said to be subject to Rule 128, or is the rule not really the law? It is the section which is the law, and so one has to look into that aspect also. So this, friends, was a brief overview of these two sections. The next is, if we go through the wordings of section 91, because this is the crux of the entire, issue of foreign tax credit in India, the wordings of these two sections and the way the courts have really interpreted them. So I'm dwelling a little longer on this just to make that point clear. So what section 91 basically says, the title is very clear, countries with which no agreement exists. So if any person who is resident in India proves that in respect of income which accrued or arose outside India and which is not deemed to accrue or arise in India, he has paid in any country with which there is no agreement under section 90, income tax, he shall be entitled to reduction from Indian tax payable by him of a sum calculated on such doubly taxed income at the Indian rate or the rate of tax of the said country, whichever is lower. As I said, the ordinary credit method, or at the Indian rate of tax if both the rates are equal. So this is the wordings of section 91. I'm taking 91 first, as I explained, for a reason. And in this definitions in section 91, the most important definition is income tax, which I already dwelt upon. The expression income tax includes any excess profit tax or business profit tax charged on the profits by the government of any part of that country or a local authority in that country, which means even the state government, whatever it charges, or even the local authority, whatever it charges in that country, so long as it is a tax on the business profits or the excess profit tax charged on the profits, then it would be creditable under section 91. Now, the one or two decisions, one or two issues more on 91, an issue had arisen before the court whether the term paid entails actual payment by that foreign entity or in that foreign country. Let's say they withheld tax under their law, and should they have paid in the same year, in the year of taxability in India? And the courts have held that the paid just means actually paid according to the method of accounting. So even if they had made a provision and paid it subsequently, the credit should not be lost. Though, of course, as I would again point out, Rule 128, and these decisions are prior to the rule. Rule 128 seems to mandate that there has to be a payment. But then, in a case where you may fall foul, then possibly these decisions could be relied upon. Then another interesting issue came up in section 91 is when you are computing doubly taxed income, whether weighted deduction under 35B in those years, or 80HHB, which was deduction for exports, etc., is to be taken into account for computing the doubly taxed income. Like, have you to reduce them for computing the doubly taxed income, or do you have to ignore them? And the court said you can ignore them, because the way, and this was in Crompton, and it was also followed by the Bombay High Court in Reliance Infrastructure. So there is a Madras High Court judgment and a Bombay High Court judgment, which have both held that under section 91, when you are computing doubly taxed income, that is when you are in a situation where there is no treaty and you are applying section 91, the words used are doubly taxed income, and the interpretation given is that the unilateral relief granted under 91 is on doubly taxed income, which means that part of the income which is actually included in the SSC's total income. Here they said the word income, as is understood in 91, would be the income as computed in the normal sense before adjustment of the deduction under 35B or even 80HHB. What is contemplated by the expression income is not an exact quantum or measure of income as computed either in India or abroad, but income as ordinarily understood in a commercial business sense. This is so because the Indian tax law may not be identical to the laws obtaining in the other country. So with this logic, in both of these judgments, or both of high courts, one is Madras, one is Bombay, they have held that while computing the credit, you can ignore these deductions and give a higher credit, so to say. Of course, you may also note that when the similar issue came up before Andhra Pradesh High Court and Rajasthan High Court in respect of 80 RRA deduction, they held against. They have taken a different view. So we have two high courts which have taken a view, a particular view. Bombay, of course, being a jurisdictional high court when we are speaking in Mumbai, Reliance Infrastructure has taken a favorable view of the matter. So very interesting to me, because the way I could have interpreted doubly taxed income would mean only what is finally taxed, but the courts have taken a totally different interpretation. Then another issue on 91 is whether resident but not ordinary resident is also entitled to claim relief under 91. The courts have said yes in Aditya Khanna's case, and they have held in favor. Then the word income used in 91 also came up before the court, whether it means gross income or net income. Because there are a few decisions, one of Rajasthan and one, I believe, of some tribunal, which had taken the view that it is only the income which is paid, that is after TDS or after the withholding tax, and you did not gross it up. In these decisions, the courts have held no, it means the net income. That is one, and the like after all expenses. Basically, it should be net income which has to be taken into account and not the gross foreign income, right? So this was an overview of 91 with some issues. Now we just quickly try and see what 90 has to say. Section 90, as I already explained, is applicable where DTAA exists. So if you have foreign income coming from a country where there is a treaty, then Section 90 is the section which grants the relief. And what does this say? It says central government may enter into an agreement with the government of any country outside India for the granting of relief in respect of income on which have been paid income tax under both the countries, or income tax chargeable under this act and under the corresponding law in force, right, to promote mutual. Now, this subclause 2 was introduced, as I said, in 2004. And this basically, the way it is worded, it just empowers the government to enter into a treaty for this purpose. However, interestingly, the courts have held, that the word income tax chargeable, because you have to distinguish between 1 and 2. 1 basically covers where tax has been paid in both the countries. And they said income tax chargeable under the act, which means though the tax is not paid in either of the two countries, it could be the source country or even the resident country, still credit would be available even in respect of those taxes. So this is the point which what I have done is I've tried to cover the case laws under 3 subcategories. to understand section 91A small 2. The first category is foreign tax credit in the 19 cases where income is exempt or deductible in the source country, that is the host country. This, friends, is covered in the treaties where there is a tax sparing clause. Now, this, credit would be available in treaties where we have, and as I said, we have 56 treaties which have a tax sparing credit. I've just put out 3 or 4 illustrations: Bangladesh, China, Cyprus, Kazakhstan, Italy. There are quite a few others, which basically say that the tax paid in this contracting state in para 1 and 2, now that means either of the contracting states, shall be deemed to include the tax which would have been payable but for the legal provisions concerning tax reduction, exemption, like we have section 10A, SEZ benefits, or whatever, some certain types of deductions under chapter 6, say for promotion of economic development. So they say those taxes, though you do not pay in that country, wherever the treaty provides for a tax sparing, you would assume that taxes were paid and credit can be claimed in India. So these are the type of treaties where credit can be claimed, where it is deductible or exempt in the other country. And the variants of tax sparing in Indian treaties, that is, there could be a tax sparing with respect to general tax incentives. I have given examples of Oman. Then tax sparing without reference to any specific tax. It's a general clause without mentioning any specific provision or of that country, Bulgaria and China. Then there could be tax sparing with reference to specified provisions of their law, which is Australia, Belgium, Canada, and only in respect of specified incomes is Spain. I've just given some illustrations. Now, in case of Oman, in fact, there is a decision against which the SLP has been admitted in the Supreme Court, is in Delhi High Court decision of Krishak Bharti, where though on the dividends there were no taxes paid in Oman, credit was claimed in India on the basis that there is a tax sparing clause in the treaty. And the Delhi High Court allowed it. There is a SLP which has been admitted in the Supreme Court and is pending. There are other decisions which I've also mentioned there: Polyplex, Chemwell, Stride Pharma, etc., where tax sparing credits have been permitted. So in cases where there is a tax sparing clause in the treaty, and this can be kept in mind. So when you are applying foreign tax credits, please look into the specific treaty. And if there is a tax sparing clause, then you could claim the credit. Then a question had also arisen whether the SSC who is claiming the credit is supposed to demonstrate that a particular exemption in that country, in the foreign country, was with the view to promote economic development. And the court said there is nothing to be demonstrated. Once there is the benefit there and there is a tax sparing clause, you will get the credit. So that was the first category. The second category is foreign tax credit when foreign income is exempt or deductible in the resident country, the country in which you are claiming credit. And for the purpose of our discussion today, we are taking India as the resident country, because credits are always to be provided by the resident country. So now this is an interesting situation, that can you claim credit? So the situation I'm talking about is a situation where the income has been taxed in the foreign country fully. And let's say in India, that income is exempt from tax. Can I still claim credit? Because the general principle is that you can claim credit only if income is taxed in India, and only to that extent. However, the question, has arisen before the courts, and not smaller courts, right up to the High Court, and a matter is pending even in the Supreme Court, whether foreign income tax credit can be claimed for when foreign income is exempt or deductible under the domestic law of India. So now I'm just giving you on this slide a comparative of two treaties, the wordings. The issue here was, this is a famous case of Wipro, Karnataka High Court, which held in favor of the SSC, where Wipro had income from branches in US, Canada, and number of countries. And in India, that income was exempt under 10 capital A. Wipro said that we would still be entitled to credit for the taxes paid in those countries, despite the exemption, because under the exemption, there was no tax payable in India on that income. But they claimed full credit for the taxes paid in those countries. And the court had occasion, it's a very interesting decision, very controversial decision, honestly, with due respect to the Honorable Court. And the matter, this decision has also been appealed in the Supreme Court, and the Supreme Court has admitted an SLP against it, which is pending as of today. Now, let's look at the wordings which the court examined. The India-US treaty basically says is that you will get a credit to the extent, like the way the court interpreted the US treaty is that credit under the US treaty is available to the extent of tax paid in USA. There is no condition in the US India treaty to say that the tax has to be limited or has to be referring to any Indian tax paid. And this is the wordings on the basis of which the court, Karnataka High Court in Wipro, came to this finding. I honestly find it difficult to accept, but the wordings are right before you. The first limb of the say that particular article says, where a resident of India derives income which, in accordance with the provisions of this convention, may be taxed in the United States, India shall allow as a deduction from the tax on the income of that resident an amount equal to income tax paid in USA. If it was ending year, then there was no issue at all, because this is very clear that whatever tax has been paid in USA, you will get a credit in India. However, it doesn't end there, because there is a second para to this article, which says such deduction, however, shall not exceed that part of the income tax as computed before this deduction, which is attributable to the income which may be taxed in the United States. So the way I read it is that this deduction should not exceed that part of the income tax being levied in India, which is attributable to the income which may be taxed in the United States. That's the way I was reading it. However, the court has read it in a different way. The court says this also refers to the tax payable in United States and nothing to do with India. So they said in the India-US treaty, and there are quite a few other treaties like Germany and France and Netherlands and have similar wordings. And they said in all these treaties, you will get credit for the tax paid in those countries, even if there was no tax payable in India on that source. Very interesting, but being an high court decision with a detailed discussion on the topic, it's an extremely academic and extremely interesting point which has arisen. So this is the way they interpreted India-US. Now, when they came to India-Canada in the same judgment, they say this treaty and treaties similar to this are very clear in their wordings. They clearly restrict the tax only to the tax payable in India. And that's how they distinguished these two treaties. Because here in the Canadian treaty, it says the amount of Canadian tax paid in respect of income from sources within Canada, which has been subjected to tax both in India and Canada, shall be allowed as a credit against the Indian tax payable in respect of such income, but in an amount not exceeding that proportion of Indian tax which such income bears to the entire income chargeable to Indian tax. So this is very clear, and here your credit will be limited only to the extent of Indian tax. So this was the decision in the case of Wipro. And Tata Consultancy Mumbai Tribunal followed the decision. It also followed this decision for Denmark Treaty, Norway Treaty, Oman Treaty, Saudi Arabia, Taiwan, all of them having similar words to US. And except India, Canada, India, Finland, they had those words which were similar, and there the treaties, these decisions restricted the credit. Now, so far, so good. There was a High Court judgment. However, I would invite your attention to two interesting judgments, actually. One in Bank of India's case, which is 2021, so much later. after the Wipro's decision was 2015, while this is a tribunal decision of 2021, Bank of India case, Mumbai Tribunal, where our respected Shri Pramod Kumar, he has authored the judgment, and an excellent judgment for any student of international tax who is interested in this subject. And he has disagreed with the Wipro decision. He has given detailed reasoning, and he said that this decision does not seem to be correct to his mind. And he, of course, said that it is not binding in Bombay, Wipro being a Karnataka High Court decision, and so he has distinguished the judgment and did not apply it. So he was of the clear view that even under the India-US treaty, the credit would be available only to the extent of tax paid in India and not otherwise. And he has discussed at length the entire international tax jurisprudence very nicely, in a very analytical and a masterly manner. And he has come to the conclusion that this decision seems to be not correctly worded. So this, friends, is the controversy as far as Wipro is concerned, and as far as the interpretation of the India-US and those type of treaties are concerned, as far as credits go. Now, the third category, which I said, is foreign tax credit in case of a loss return in the resident country. So let's say you have not an exempt income, but you have losses in the resident country. So you had incomes in the foreign branches. However, you had, on an overall basis, the resident country, there is a loss return. Can we claim credit in such cases in respect of the foreign tax? And this issue arose again before Sri Pramod Kumar in the case of Bank of India, which is another judgment, where he again it's a very detailed judgment where he has discussed this point, and of course he rejected it. He said the law in India, of course, does not provide for such credits because the law is clear that only if to the extent of Indian tax payable, and there is no provision for carry forward of foreign tax credits. However, the argument of Bank of India was interesting. What they said was that when there are losses in India, so to that extent, the foreign income is being taxed in India because my losses carry forward is getting reduced because I'm setting off those losses. So in future, I'll be paying tax, which I should have, so I should get credit in future whenever you tax me because you have reduced my losses to that extent. And there, Mr. Pramod Kumar has mentioned very clearly that though the way the rule is worded, it does not seem to allow any carry forward of credits. However, this issue cannot be said to be closed, and this argument could be possibly taken in future, as and when there is a tax payable by Bank of India, and they could possibly still raise this issue in future. So, which because he said in most of the countries there would be a carry forward in such situation. The India does not provide a carry forward, in a specific manner, but surely the courts can look into that aspect at that time, right? So this was another interesting judgment which needs to be looked at. So Bank of India's decision and the Wipro's decision, these are two must read for anybody really wanting to study the subject of foreign tax credits from an Indian perspective, is my view. And of course, the third judgment I'm going to come up with the Reliance infrastructure decision of Bombay High Court. So these three decisions actually, if you really go through them, and most of the doubts or issues which arise will be there. So this was on section 90 and 91, an overview. Now let's see whether there is an possibility to claim credit for taxes. Let's say you are dealing with a treaty country, and as I said, section 90 is the one, and that would govern you. But is there a possibility that in those cases also you could try to claim credit for state taxes, even under 90? Is there any way to do it? Because as I said, 91 clearly allows it. Now, whether 90 can be stretched to allow it is the next issue that I'm taking up. So here again comes Wipro. the same decision of Karnataka High Court. This again was a question before the court that the credit should be allowed even in respect of US state taxes. So what the SSC argued was that under 91, I am going to get all the credits. However, 91 I can approach only if there is no double tax treaty. While in this case, I have a treaty with US and I have paid state taxes. I I'm being, and I'm section 90 also allows me to select whichever is more favorable. I can be governed by the act or the treaty, whichever is more favorable to me. In this particular case, the act seems to be more favorable to me. Why am I being thrust with 90? Why should I not claim credit under 91? And the court said that they found another way of giving that relief in Wipro. They said that India has not entered into an agreement with the state of USA, any states of USA. It has entered into an agreement with the United States of America, but not with any specific state. So and 91 basically says that where there is no agreement entered into, then any taxes by any part of that country also could be claimed. So they said because of that, is in respect of those taxes where I have not entered into an agreement with any particular state of USA, I can give relief under 91, and they gave relief for the US state taxes. So foreign tax credit was allowed to a case where treaty existed by the Karnataka High Court in Wipro. Now, then came Ahmedabad Tribunal, and I'm a fan of Mr. Pramod Kumar, to be very honest. And so this case of Rajiv Modi has agreed with the Karnataka High Court, but they found a different way of agreeing. They said that 90 or I'm entitled to claim under the act, whatever is more favorable to me. 91 is allowing me credit for state taxes. 90 does not seem to allow me, and which does not seem to be right. It is not as per the spirit of the act. And so we are going to allow this credit for state taxes in this case. So Rajiv Modi's case, they also allowed credit for the US state taxes, even in a case where there is a treaty. So these are the two very interesting decisions on this aspect. Then the only thing to be kept in mind is that if you claim 91, US state taxes, you have to remember that credit can only be in respect of doubly taxed income. So that is something where you will not then be able to go to the treaty and claim tax sparing and all of those things. So you have to be careful when you compute. And you cannot claim credit under 91 in respect of incomes which are deeming to accrue or arise in India. So they should not be falling within section 9, those type of incomes. So beyond that, it seems to suggest that with these two judgments that you almost have an option, even if there is a treaty, to select 90 or 91. Of course, this is not the last word on the subject. I'm sure there's a lot more, because as I said, Wipro is before the Supreme Court. So let's wait and watch. But very interesting aspects. The other decisions on the same point, Tata Sons also allowed state taxes. Aditya Khanna allowed, and there is one decision against of Delhi Tribunal, which is Manpreet Singh Gambhir, where US state taxes credits were not allowed. So this was the interplay of 90 and 91. Now we come to some more interesting issues. Having understood 90 and 91, and I hope I'm clear and people are finding this interesting. Some very interesting other issues. Let's go to. Here came a issue whether if I'm not getting credit, either under 90 or under 91, if credit is not being given to me for whatever reason, under 91, I will not get credit on the ground that income is deeming to accrue or arise in India. And so 91 credit may not be given. Otherwise, 91, of course, allows credit for state taxes, etc. In 90, I will not get credit because the tax is not of the nature covered in the treaty. So in those situations, can I claim deduction under section 37 bracket 1 for those taxes? So they are income tax paid to the state, let's say in USA is one example, and I'm not getting credit for whatever reasons, then can I claim deduction under section 37 bracket 1? And this came up before the Bombay High Court in the case of Reliance Infrastructure. And the Bombay High Court held in favor of the SSC that such taxes you could claim credit, you could claim deduction under section 37(1). But again, Mr. Pramod Kumar's decision in case of Elitcore Technology, attaxman.com, Ahmedabad Tribunal, which again does not agree with Bombay High Court judgment, and being in Gujarat, Ahmedabad Tribunal being in Gujarat jurisdiction, did not follow Reliance Infrastructure. He of course followed Reliance Infrastructure when he was sitting in a Mumbai bench by saying that I'm bound by that decision, it being a jurisdictional High Court decision. However, very interesting decision, Elite Core Technology, which distinguishes or does not agree with Bombay High Court, and I'll explain quickly why. Now, to understand this controversy, one has to understand the scheme of section 40A bracket 2, small 2, which basically prohibits deduction under as an expense of any amount or any sum paid on account of any rate or tax levied on profits on gains of any business or profession or assessed at a proportion of such profits, right? So this is 40A small 2, which basically denies deduction of income tax or any tax in the nature of income tax. Then there is an explanation which was added in this 40A small 2. It says for the removal of doubts, it is declared for the purposes of this subclause, any sum paid on account of tax levied includes and shall be deemed to have always included a sums eligible for relief under 90 or under 91. So this is the section which we have to cross before we can get a deduction under section 37 bracket 1. To say that, okay, first we have to cross this threshold and then we could claim 37(1). Now, when the issue came up before the court in Reliance Infrastructure, the way it was held by the court and argued was that the explanation 1 basically restricts this denial of deduction only to taxes which are covered, firstly, only to income tax as defined under the Income Tax Act, and secondly, only to the taxes which are covered under the treaty or taxes which are covered under Section 91, nothing else. So if there is a situation where a tax, like for example, US state tax, is not covered under the treaty as a tax for which credit will be given, then in those situations, section 40A small 2 does not apply. That was the line of argument taken and upheld by the court in Reliance Infrastructure. They said that after this explanation, if you don't read the explanation, then any income tax could not have been ever claimed. But they say the explanation seems to restrict the section, the 48(2), to say that it is only to that extent that the section has to be read in. Now, this interpretation was, in the contrary decision of Elite Core Technology, Mr. Pramod Kumar again has said, and I again, with due respect to the Honorable Bombay High Court, I tend to agree with his analysis, which he has basically said that the explanation cannot widen the section or restrict the section. The explanation is only giving some meaning or some additional meaning, but the basic section 48(2) basically says that no deduction will be allowed for any rate or tax. Again, he has also harped on the word rate. He says it's not only tax, it is also rate or tax levied on profits and gains, etc. And he has said that the interpretation of the Bombay High Court to say that it is to be restricted only to the income tax or tax covered under the treaty or tax covered under Section 91, etc. He does not agree with that. And in the case of Elite Core, and he has relied on another Bombay High Court old judgment of Lubrizol, which was for surtax and which was approved by Honorable Supreme Court. That was the decision he relied on as taking a correct view of the matter. And he has, being in Ahmedabad, as I said, he said this is not a jurisdictional high court. That was Bombay High Court. This is in Gujarat, and I'm not agreeing to that. So that is on 37.1. But otherwise, as of today, there are a number of decisions which have come which have allowed state taxes after Reliance Infrastructure. Being a jurisdictional high court in Bombay, clearly this is allowable. And this is binding till, and this of course is not pending before the Supreme Court. At least to my research, I could not find that this decision there is any SLP pending. Maybe I am wrong, but whatever research I carried out, I could not get anything to that effect. So as of today, sitting in Bombay, US state taxes can be claimed as a deduction under 37.1, even if one assumes that Wipro is incorrect and maybe Supreme Court might reverse it, then you could claim 37.1 for sure, as till this decision holds the ground. Then another interesting issue came up before the courts is whether full credit is allowable under India-US treaty and alike treaties, or is it limited to ordinary credit? I think I already covered it in Wipro that the way they interpreted the India-US treaty, they said that full credit would be allowed. In the sense, even if there is no tax payable in India, credit would be allowable. Again, as I said, seems to be an incorrect decision. I refer to Bank of India's Bombay Tribunal decision, which has taken a different view of the matter and given a detailed explanation why they do not agree with the Wipro decision and did not apply it. And so this issue is really alive. Matter is pending before the Supreme Court. So the way the US treaty and all those line of treaties are been interpreted as allowing full credit. Uh, so which means despite no tax or lesser tax being payable in India, still a credit being given for the taxes paid in USA, which Wipro allowed, is another issue. Then the next issue which we can take up is on the characterization of income. Now, when it routinely happens that the way the source country may characterize a particular income in their country as per their law may not be the way the resident country may characterize it. It could be, for example, India characterizes incomes in the form of royalty, FTS, while the resident country may treat it as business income. And that happens even when an Indian recipient is there. So when the character or somebody may characterize, some law may characterize something as a capital gain or as an income from other sources, for example, while the other country may have a different characterization of such income under their laws. So does the treaty benefit get curtailed in any manner because of different characterizations in the source country and the resident country? This again came up before the Calcutta Tribunal in Somdat Builders. It was held in favor of the SSC that, and again, there is an old Supreme Court judgment in case of, I think, Ramaswamy Chettiar, which also has held that it is not necessary that they should characterize in the same manner. The only prerequisite is that the income should relate to the same person and should be taxed in that same year. That is the only two requisites. It is not, the characterization really doesn't matter. Then another issue came up was on, can foreign tax credit be denied on shifting of tax residency? Now here what happens is X is an employee who seeks voluntary retirement while serving for a company in the state A, and he comes back and becomes a resident of India. State A can claim that VRS compensation paid to X is sourced in state A as it related to employment in state A. So when he is now become a resident of the other country, can the FTC be denied to him? And So there again, Hewlett Packard is the case of AAR, which has held that no, in such cases where it is genuinely otherwise allowable to him, merely because of shifting of tax residency, credit should not be denied. So that was another interesting issue. Then a point came up before these decisions where whether foreign tax credit can be considered at withholding stage, at the TDS stage. And it was held in favor in British Gas, Coromandel Fertilizers, and Texas Instruments, where the court said that yes, it can be taken into account even at the withholding stage. Then is foreign tax credit eligible on the basis of income received or on the basis of gross receipts? So that means if suppose I'm receiving some income which is in the nature of business income, am I to, firstly tax it on the basis of gross or on the income? Answer is clear, it should be the income. And then whether the foreign tax credit, because the TDS may have been deducted on gross basis. So whether I should claim credit on that basis or on the basis of income. Here again, it has been held very clearly that it should be on the basis of income. As I already said, Elite Core Technology decision of Ahmedabad Tribunal discusses how to in fact compute the allocation of expenses, etc., for the purpose of claiming credit. Then hierarchy of tax credits, like what is the chronology in which I should claim tax credits. And here the Karnataka High Court in Sami Labs has held that first the credit should be given for the non-refundable taxes, which is 9190 MAT, and then to the refundable taxes. So that again has been cleared by, it went up right up to the High Court for that matter. Now, these are questions which are, there are not clear answers, even as of today. For example, how foreign tax credit would be available in case of fiscally transparent entities. Let me give you an example. Now, if suppose we have a resident individual, and this lady was a resident of US, a citizen of US. In fact, she is a citizen of US. She was a doctor practicing in US for a number of years, employed in US for a number of years. Now, for quite a few years, she has been a resident of India. Now, when she was in US, she has made investments in her retirement funds as well as in number of investments in mutual fund type of funds, right? Now, in USA, those retirement funds would be taxed only when she will retire or only when she achieves a particular age. And the other funds are, some of them are pass-through funds. So which means whatever the fund earns is taxed in her hand in the US. For example, if the fund earns some capital gains, some could be short-term gains of the fund, some could be long-term gains of the fund as defined in USA. Some could be dividend income, interest income, or the same character of income she files in her US return in the same manner. And she pays the taxes in her individual hand. The fund don't pay tax. Now, when you come to compute Indian tax of this person, as well as the credit, now that's been a confusion as to whether, number one, whether at all in such cases, because she has not sold any of those units of those mutual funds. As far as retirement funds go, we have now a section 89 capital A read with rule 21 triple A, which I will come to. But as far as non-retirement funds go, there are two issues which arise. One is that under the Indian law, capital gains would arise only when she will sell or redeem any of those units, which she has not. Though those funds are passed through in USA, as far as India is concerned, there is nothing to say that you have to tax whatever was taxed in USA in our hand. That's one theory. And so one option is we don't show any income of that type of a person from those funds till she actually sells or redeems some unit. That's one possibility. And so we don't claim credit for those taxes which she pays in US on that income. That's one possibility. Other interpretation could be that, I show all the income as far as her US return is there in the Indian return and claim full credit or claim credit for whatever tax she paid on that income. in the respective year itself, and don't wait. And as and when she will sell the or redeem the units, I don't pay any tax on the ground that I already paid tax on the income as and when it was earned. That's the second option. Now, as far as the interpretation of the way the law is, in my view, the first seems to be the correct one, that in India there is no tax till she actually redeems or sells those units, and so no tax is payable, no credit would be available. But when you go to the practical aspect of it, because if you try to do that and go and face the income tax department, there is going to be total confusion, because how are you going to keep a track of such credits and such incomes as and when she will redeem, and which year are you going to go back and claim credits, etc. It's going to be extremely difficult on a practical basis. So on a very practical basis, the income tax department basically asks you to match her US return with the Indian return and show that all the income which is in the US has been shown in India. So on a practical basis, it becomes very convenient to show that income. The only difficulty which arises is when there is capital gains, short term, long term of those funds, you don't have the dates of sale or purchase by the funds. So how are you going to fill the return form? How are you going to put all those data? And in absence of those data, can the return be treated as defective, etc.? So these are aspects which are not very clear. And in a practical course, one generally tends to take a view which is a little more convenient than what is really theoretical, because it's extremely difficult to keep track of these type of, because it's a amounts can be large, and it could be a number of years before she will actually sell or redeem anything. And even if suppose she redeems some part in a particular year, how are you going to compute the income relating to that? Then the other is about self-employment tax. In USA, there is something called self-employment tax paid by a resident individual, even if he is, uh, carrying on some sort of a, I have a case where he's a director and fully employed, and still he pays a self-employment tax. In my view, this is something akin to a profession tax in India, and no credit can be claimed for the same. So the next segment, which I'm very quickly going to cover, is this 89 capital A and Rule 21 triple A introduced in our Act. Basically, they were introduced in 2021 Finance Act, and they provide for mismatch, because as I said, retirement funds in most of these countries would be taxed only in the year of withdrawal from those funds, and not on an accrual basis. So there was a mismatch, and so this basically section was introduced along with the rule and a form to allow the SSC to file that form, and to claim an option to be taxed only at the time of withdrawal from such retirement funds. So this is a benefit given to such cases where they are now residents and were earlier residents of foreign countries. Then Article 5 of the MLI, just to complete my subject, as you all know, in MLI there was options. India has selected option C, that is credit method over the exemption method. And these are the treaties which are not affected by the MLI, Indian treaties. There is Egypt, Bulgaria, Greece, and Slovak Republic. So to that extent, because one of the other country may not have accepted that particular aspect. So these treaties remain unaffected by the MLI. Otherwise, in other treaties, India's would be the credit method and not the exemption method. So this, with this, friends, I think I've concluded my presentation. I have kept exactly 10 minutes time, plus I'm ready to extend by some more time in case there are any questions. I'll be really happy to take them. Over to you, Kush.
So at the moment, there are no questions in the question panel. But in
Yeah.
case anyone has any questions, you can just type them in now.
And even if they wish to ask, I'm fine.
Yes, Sushil, I will ask
Yeah.
one question.
Yeah, please.
See, India has the financial year as the year, and the taxation in the other countries may not be as a financial year, but maybe calendar year, July to June, and so on. So, how do we calculate the FTC if the foreign country taxes it on a calendar year basis and India taxes on the financial year basis?
Yeah, here again, Nilesh, the answer as per the law is that you have to compute income financial year wise. That means from 1st April to 31st March. So you will take the returns of that country, then proportionately or whichever way come to arrive at the figure for this particular financial year and corresponding credit. That is the law. But on a practical case, let me tell you, because we tried doing that in a few cases of individuals, and we found that we were almost breaking our head against the wall trying to explain the working. On a practical basis, when I consistently am following calendar year's income when I'm filing for Indian financial year, and I keep following consistently and I claim credit as per the US return, I'm finding things go very smoothly because I can show the return, match the figures, and the credit is given. And there has been no questions till date asked. Though, as I said very correctly, it's not as per the law. As per the law, I would have to compute as per the financial year and claim the credit. So that is the law. Now, one could either follow the law or I learned the hard way that following the law may not be the best method at times.
But then it is a challenge to.
It is always a challenge, but these are, you have to look at the practical challenges because otherwise you'll never get credit. Because when you try to explain even at the higher levels, very few are really aware of all these provisions. When you're talking of individuals, who are residents of India, you are going to the resident wards and not to the international tax wards, etc. They are not really aware of all this. And it becomes extremely challenging unless the government comes out with some clarity on the subject. There are quite a few Indian residents now who were non-residents earlier, who were US citizens or citizens of other country, and they have these issues all the time. So I think the government needs to be aware of this and try and make things streamline situations. I believe some questions may have come now because
Yes, sir. I'll just say them out loud and then you can answer them.
yeah.
The first question is that you've been requested to elaborate on how FTC can be taken when tax is withheld on a gross receipt basis and income
Yeah.
is taxed on a net
Yeah.
basis.
Yeah, I think I already answered this because FTC would generally be taken on gross basis. Means FTC would be always deducted on gross basis. Even when you look at India, we deduct on the gross dividends or interest or whatever. But when it is taxed in the resident country, it would be either taxed as a business income or if it is taxed as an interest income, there could be a section 57(3) type of a situation where you could get some deductions. So it would be taxed on a net income. So for example, if you had 100 gross income, but your taxable income in India is only 70, let's say, on that particular source, and the tax payable in India is 20. I'm just rounding off. So on 70, you are paying 20 rupees tax, while the tax which was deducted on 100 is, let's say, 30. So you will get credit only to the extent of 20. You will not get credit for the remaining 10. I hope I've answered this correctly.
Yes, sir. And then, sir, if you can answer what will happen to that 10 rupees which was lost,
Yeah.
can it be deducted under section 37? That will answer the third question, which is there.
Yeah. So honestly, no. In my view, no. You can't because this is a tax which is covered under the treaty, and you cannot now say that to whatever extent I could not claim credit out of that, I'm going to claim 10. I think that would be stretching the law a bit further, but I cannot rule out some court agreeing to your view, Kush. I cannot rule that out for you because the way the decisions I've explained, I cannot rule that out. But the way I understand it, I honestly don't think you can claim for that 10 deduction. But I'm sure there are. Nilesh already has his eyebrows up, so maybe he has another view of the matter.
No, I think claiming that 10 rupees is perhaps, as I agree with you, it is stretching it too far. I was just reading another question in response to your example of 70. Kush, can you read the last one which has now been put up?
Yes, the question is that how to allocate the expenses to arrive at net income of, say, this 70. Can the HO expense also be allocated?
No,
Should
as I said, this will go to a case specific issue. I am inviting your attention again and again to the decision of Ahmedabad Tribunal in Elite Core Technologies, where Pramod Kumar Sahab has dealt with this aspect in detail about allocation of expenses. What can be allocated, what cannot be allocated, what is the basis of allocation for the purpose of credit only. So an extremely interesting and useful decision. Because if you start discussing allocations of expenses, then I think we are departing from the topic that we are at.
Correct.
So that is a every case would have a different working. Yeah.
Yes, sir. So one question says that if an Indian company declares dividend which is received from a foreign shareholding and it claims ATM benefit, in this context, whether FTC credit will be available on the taxes paid on the dividend received, although that income has been deducted by way of ATM.
So as I said, already there are these judgments which I've referred to. I'm assuming like if you are under 91, then it is only to the extent of doubly taxed income. In this case, 91 is slightly worse off because, but again, the courts have tried to say that when you talk of the word doubly taxed income, you don't have to take income in the tax act manner, but in the commercial sense manner. And so they have, in fact, allowed certain deductions, but controversial. But when you talk about the treaty, then there is a slightly better case where you could possibly try to claim even despite that ATM the credit. But that's what I have tried to point out. The decisions presently, the high courts have taken favorable views on these matters. I'm not sure whether it will withstand the Supreme Court scrutiny. Wipro is before the Supreme Court, and so one waits how the courts are going to look at this. But the issue that you have raised is before the Supreme Court pending.
So in case of ATM itself, like how if the company will redistribute the dividend to its shareholders, and they will pay tax on that dividend. Should also the foreign tax credit similarly pass on to the shareholders, and they should be allowed to take credit in their hands?
Yeah, this is now you're talking of an alternate plea being made, saying that if you don't allow me this, then allow the shareholders. I do not know. The law will evolve. As far as today, I think claiming deduction despite ATM is a possibility. But if for some reason that goes against, then one has to try this alternate plea, but a bit difficult the way our law is. But there's never, never say never in our law, and that is the fun of the whole thing.
Sushil, we saw the case of PwC and few others that the claim means Form 67 can be filed later on also, and the credit should be allowed. And now Form 67 time limit also has been officially extended up to the end of the assessment year. In fact, before the amendment, I had a very peculiar case that on the last day of the filing of the return, my client was in the ICU, and I had to disturb his family that you please give me the OTP, because without that the FTC would be lost. So this is one relief in such a case. But the question is that what are the avenues available to claim such a credit? Because you're with the faceless regime and the now the returns are being processed very fast. So how do you
will
raise
see the way? No, the way the courts have said is that this rule is not a mandatory in nature. If there is a credit which is legitimately available to you, nobody can deny it. That's the spirit of the decisions.
Agreed. But
and so in a practical manner, like in faceless also, even if there is a because they say even if no claim was made in the return, or even in the assessment stage, you could even make the claim in the appeal stage. So you are permitted to make that claim is what the court is saying. And, so I believe you will have to follow that and try and claim it.
So even if there is no issue, I file an appeal to keep the matter alive, and then I take it
claim a additional ground. Yeah.
I think it would have been better had the notification also said that it will get covered under 154 or 155.
You can always represent, no? because this is not in the act. This is only a rule. So there are number of case laws on interpretation of these rules that they are not really, whether they are directory, mandatory, those type of situations where the courts here have said rule 128 is not mandatory. As of today, that's the line of thinking of the courts.
Okay, I
So there's
think
one last
we have
question.
come to the end of the session.
So there's one more question.
Okay, take it up.
It says that if an Indian LLP is incorporated as a transparent entity, incorporates a transparent subsidiary in the US and is carrying on business in the US, and this income is earned in the US is taxed in the LLP's hands in the US and also in India. So in India, will the LLP treat this as business income or as dividend income?
Now, the way there is some confusion in the question, the way I understand, if it is taxed in the hands of the LLP in USA, and it is the same LLP which is getting taxed in India, because what is to be taxed in India is the resident of India, right? Now that LLP is a US LLP. If the way the question is worded, the LLP is in USA, or is it an Indian LLP earning
Indian
income?
LLP, which has a subsidiary in the a transparent subsidiary in the US.
Okay, so the income is taxed in the hands of, and if the nature of the income, see in all transparent or pass-through cases, the nature of the income would be the same as it was in the hands of the parent or whatever entity was there. So, I see, it will depend on what was the nature of the income in that hand. It would be the same nature, I believe.
But I think you mentioned
Unless the income is of a nature where the Indian Income Tax Act has some different, characterization. Let's say that may be another reason to see. Otherwise, the LLP. Yeah.
You mentioned while you were during your presentation that it would be a good idea to then declare this income from US to India and distribute it and show it as business income in the same year instead of waiting for distribution.
Yeah.
Then probably they can take the same nature in India as well.
Yeah, but see, in generally, when we are talking of, a US LLP or a US transparent entity, the individuals would be taxed in the US.
Correct.
And claiming credit in India would be quite simple because the Indian, it's only in a case of this nature where there is an entity coming in between.
Correct.
But I believe they should be able to get credit. Yeah.
No more questions.
Okay, so Sushil, I will compliment you on a very comprehensive presentation of the trickly issues and which are of very practical relevance. I'll request Kush to propose a very formal vote of thanks.
Yes, sir. So thank you, Sushil, sir, for wonderful session. Although the taxpayers may not get credit in some time, but full 100% credit to you.
Thank you.
For enlightening us. And thank you for taking your time and answering all the questions.
My pleasure. My pleasure.
Before we leave, some announcement for IFA members that the membership fees for 2023 are due before 20th of Feb to 8 last end of this month. So please do so to continue your membership. And for non-members, you're invited to try and take benefit of IFA membership and become members because more sessions like this are going to be held, which would be free of cost or subsidized cost for members and would be chargeable to non-members. So I invite non-members to also apply for IFA membership.
Okay, thank you. Good night.
Thank you.
Everybody.
Thank
Have
you,
a great
everybody.
day.
Thank you so much. Bye-bye.